In this part, we're going to do a detailed weighted average cost of capital calculation. So weighted average cost of capital was one of the key components upon doing a DCF analysis. Along with terminal growth rate, it is the sole component that really has a critical impact to the valuation results. However, in our 201 class, we simply just hard-coded weighted average cost of capital numbers, and now we're going to try to calculate weighted average cost of capital like we actually do in actual practice. So a little bit of recap from Financial Modeling 201. So weighted average cost of capital, we refer to the average costs when financing from all types of investors. So whether you finance your capital from debt, equity, or preferred equity. Thus, the formula was debt ratio times cost of debt, the equity ratio times cost of equity, preferred shares ratio times cost of preferred shares, all weighted average and added up together. However, in case of debt, for the debt portion, we also added a tax shield since interest expense is tax deductible. So what we're going to try to do is try to designate a company. For your information, we're going to do Marriott International, one of the most famous hotel franchises in the world. We're going to try to calculate weighted average cost of capital for that specific company. However, we do need these specific data points in order to calculate weighted average cost of capital. So we need the debt ratio, the equity ratio for the company. Luckily, the company does not have preferred shares, so we're going to just ignore this part on the bottom. We also need data on cost of debt. We also need the tax rates for the company. And lastly, we also have to calculate cost of equity. All other components are relatively easier to understand since debt to equity ratio is very straightforward. Cost of debt is also very straightforward. It's very similar to interest rates. Tax rates are also straightforward, but in terms of for cost of equity, as we remember, we usually use this formula. For those of you who don't remember, this formula was called capital asset pricing model. So the concept was to try to calculate cost of equity from the investor's point of view, and from the investor's point of view, cost of equity equaled required rate of return. So the equity investors require this kind of return. It added up from three individual components. We had risk-free rate. So it's the minimum rate of return that the investors want. Usually we used US Treasury yields, which is the most risk-free asset that exists. And then we added a little bit more premiums according to the risk of the investment. First, we had investments that was related to the asset itself, asset characteristic itself, because if we consider this government bonds, equity or stocks by nature is much more riskier than bonds. So we added a risk premium for that. We also added a market risk premium because, if we consider risk-free rate as US government bonds, US is considered one of the least riskiest countries in the world. So if you're trying to calculate cost of equity for China, for example, it can be considered a little bit more riskier than investing in the US. So we add another type of risk premium called the market risk premium, which is for the geographic risk. And usually these two are combined, and we call it equity risk premium or market risk premium, terms that are sometimes used interchangeably. And then we need to account for the individual stock's risk. So we only consider risk that are related to the company itself and the stock itself. But individual stocks have different risk rates. So that's where beta comes in, and If beta is 1, it means that it has the same riskiness of the stock market itself. If the beta is 2, it means it represents that it has twice the risk of the market, and so on. So in order to calculate the weighted average cost of capital for Marriott International, we need 7 types of assumptions. First, we need the debt ratio. We have to calculate the debt ratio. Of course, you can always use the company's current debt ratio or the equity ratio, but in many cases, debt to equity ratio changes over time. So in actual practice, we often see analysts use peer groups capital structure average. So we're saying that in the long term, in the long run, the debt ratio of Marriott International will also become similar to the peer group. So we're going to do that. Of course, once we have debt ratio, we can just subtract debt ratio from the 100%, and we'll simply get equity ratio. So we're going to do that. Next, the tax rate and the cost of debt. For the tax rate, we can simply use marginal tax rates of the country where the company is incorporated. Cost of debt, there are many ways to calculate cost of debt, but for our example, we're going to use target's effective interest rate. In other words, we're going to divide interest expenses for the past 5 years by average total debt outstanding. Of course, if you have yield to maturity data or recent information about the company's cost of debt, you can also use those information as well. But we're going to just try to utilize the data that we can have access as a general investor. And the last part, we have to calculate cost of equity, and it has the most components. Risk-free rate, we need the equity risk premium and the beta as well. And actually, this is one of the parts where it's most affecting weighted average cost of capital, because usually companies have a very higher equity ratio, equity structure. So most companies have little debt compared to equity, especially companies that are listed, and especially in most industries, I think debt ratios have little effect compared to equity ratios. So cost of equity is very crucial, a very crucial part to calculating weighted average cost of capital and DCF valuations. So it's very important what assumptions we make for cost of equity. For the risk-free rate, generally people use current US 10-year Treasury bonds rate of return. Some sources use 20-year bonds and so on, but we're going to use 10 years. Equity risk premiums and market risk premiums, if you have access to Bloomberg or some other service provider, they provide you with equity risk premiums with their own logic, with their own calculations. As a general investor, we do have access to Damodaran. He's a very famous professor in New York. He constantly updates numbers related to weighted average cost of capital, and even in Wall Street or even in Singapore, Hong Kong, very famous financial hubs, analysts use this source in order to calculate weighted average cost of capital. So it's one of the data points that we can really rely on, and one of the data points that general investors can have access to. So we're going to try to leverage that and try to calculate. Another source that we're going to refer to is called Kroll. We're going to show you that in a moment. I think it's not a non-profit organization like this source, but they also do have some free resources that we can utilize. So we are also going to use that source as well as reference. Lastly, for beta, this is the most crucial part, I guess. So there are many ways to calculate beta, but the most popular and the most common way to do that is to calculate peer groups beta. So we're going to derive peer groups beta. So for Marriott International, we have peer groups like Hyatt or Hilton, Intercontinental, other hotel franchises. We're going to calculate those companies' beta. We're going to do an average of those companies' beta. We're going to unlever it, exclude the effects of debt to equity ratio, and we're going to re-lever it based on the target's capital structure. So the capital structure is Marriott International's capital structure, target capital structure, which is the average of the peer groups. And the beta itself would be also the average of the peer group's beta. And lastly, there are many types of beta depending on the time frame of where you observe it historically. So we have 5-year monthly beta. So we're tracking share prices for the past 5 years based on a monthly basis. So basically this means it has 60 data points, historical data points, which this is the most popular. I think analysts think that this represents historical market trends the best, because markets have their ups and downs and cycles and everything, and maybe 5 years is the term you want to see if you want to get an idea of an average beta. So 5-year monthly beta is most popular, but for companies that have shorter history, and if the last 4 or 5 years was a very unusual time frame, and if you want to exclude that, people also use 3-year weekly beta or 2-year weekly beta. Other types of time frames can be also used, but yeah, 5 years monthly beta is most popular, so we're going to do that. We're also going to make some scenarios where we can select different time frames of beta, different sources other than Damodaran, and eventually try to calculate different 3 types of weighted average cost of capital as we did in our scenario analysis. This is simply because this single input is extremely important, and depending on just a 0.5 percentage point change can change the valuations dramatically. So that's why we do that. So our calculation steps, we're going to start from making a frame for calculating weighted average cost of capital. And then we're going to fill in the inputs just one by one. We're going to start with the simple part. We're going to start from cost of debt. We're going to start from cost of debt, equity risk premium, and risk-free rate. And then as we have most of the simple data filled in, we're going to build a peer group table as we did in trading comps valuations. And we're going to calculate the capital structure. And lastly, we're going to calculate beta. We're going to manually calculate the peer group's data as well as Marriott International's beta. We're going to unlever it and then re-lever it. And that's going to finalize our weighted average cost of capital calculation. So download the raw materials. We're not going to use our existing model. We're just going to do a separate task on a separate spreadsheet. So please download the raw materials and let's meet at our Excel spreadsheet.